The stock market continues to hit new all-time highs, something we're seeing nearly every single day, and investor sentiment sitting in the region of extreme greed, showing that no matter the volatility that we're getting in the market, even with earnings, one thing is for certain: at these extremely stretched valuations, retail investors continue to buy. Not only are they buying, in fact, we're seeing record amounts just in the most recent period, 155 billion of funds coming into the market. And actually the main reason why we are seeing these new all-time highs is retail investors. They are the ones who continue to add more and more, whilst institutions for the large part have been doing the opposite. We've seen in the most recent quarter they've been dumping billions and billions of shares in some very well-known and large companies, and it isn't just the likes of the Mag 7. We're seeing this right across many names in the S&P 500, and in fact analysts are now getting a bit concerned around what the institutional strategy is. They have in fact been selling 9 out of the last 10 weeks, with the third consecutive week unloading $1 billion. And it's not only them, we're also seeing a very similar thing going on with members of Congress. They continue to be dumping not only shares in general, but in some very specific stocks, and that is what we want to uncover today. Because ultimately members of Congress do have the edge. They seem to be outperforming the market every single year. In 2024, some of them in fact were producing triple-digit returns, and that also holds true for 2023 or any year if you want to go back and look at the data. And we can see some of the more popular members of Congress like Nancy Pelosi, who has in fact made in 2024 more than $24 million. And it wasn't that long ago that we did uncover some of her buys and sells. In fact, in the most recent month, we can see she exercised her call options on Broadcom, which was around $5 million worth, whilst also selling a fairly small position. But remember, reason why she is constantly looked at, her outperformance is definitely something to take note of, up 733% against the S&P's 239. And interestingly, if we look at the beginning of 2023, there were 78 members of Congress who had been identified as doing some kind of insider trading, and it probably isn't great to hear that the penalty for this, if found guilty, is around $200. And even if we take it one step further, no member of Congress has ever been prosecuted for insider trading. So we want to have the edge, see what they're doing, and we're going to get straight in to the 8 stocks they have been dumping. The first stock members of Congress are in fact selling is one they've been doing so for quite some time, and you could argue it may be reasonable given all of the headlines we've been hearing about the likes of Walmart, Amazon considering to issue their own stablecoins. This is ultimately to circumvent the need to spend billions of dollars on network fees, something we've also heard that China are willing to accept. And if we do see retailers starting to accept stablecoins, then ultimately it will result in lower card fees, and that will harm companies like MasterCard as well as Visa, which is one company members of Congress for a very significant portion and time have now been dumping. Over the last year, it is up 41% though, very strong performance. Year to date, also pretty decent, up 13%. And if you've been a longer term shareholder, you would be up 374%. Now, each one of these stocks, we're going to do a quick analysis, our own valuation, and also, as we've just done, highlight perhaps why they're looking to sell. We also can flag that this company is trading at the upper end of the 52-week range. We also see a double buy from Seeking Alpha as well as Wall Street. Wall Street 4.32, not far off the 4.5 to flip them into a strong buy. So they actually disagree with members of Congress. And we should also flag that Visa are reporting their earnings after the market close on Tuesday, so do anticipate some volatility. And if you're interested to see for those companies that have already reported their earnings, this is the performance on that particular day, which does highlight, because a lot of these did perform fairly strongly, that unless we see something very stellar from companies where valuations are already stretched, they will ultimately get punished. And for Visa in particular, it's trading at a forward P of 30, which does sit above the 5-year of 27.6. This, in one way, is a potential overvaluation signal. Bear in mind, we're not looking at this model in pure isolation. We'll get to our own DCF process shortly, but also factor in that the yield of 0.66 on offer to shareholders today is lower than the 5-year historical at 0.73. And if we go one step further and look at the blue tunnel here, remember the parameters within does signal the expected fair price, intrinsic value. It is sitting at the upper end, so you could also factor that into the two previous points that this company does look potentially overvalued. And if we were to zoom out over the last 5 years, this is actually one of those companies that more often than not is very rare to get at a severely undervalued level. There was quite a number of years where it was trading severely overvalued. At least in the most recent year, we do notice it has been trading at the upper end. And they do get a B- on their overall growth score. We can see year on year, 10%. They're expecting around 10% again, pretty consistent in 2026, which is above the sector. That's always good to see, but pretty much in line with their own 5-year average, telling us, at least for the short to medium term, Visa has in fact been very consistent, whilst they're projecting 12% EPS growth over the next 3 to 5 years. That is a little bit of an improvement on where the sector believes it will be at 10.3, but actually slower than their historical 15.6. One thing we always love to see is pretty much green right across the board. Over the last 4 quarters, they've either been in line or outperformed. They're expecting this coming Tuesday to increase the EPS by 18% year on year. Pretty much the next 4, in fact, double-digit growth. Great to see. And if you do have faith they'll hit their targets, then they are currently trading on 26 numbers at a forward P bang on 28. We'll also quickly look at what the institutions are doing with their 82% ownership, selling 37 billion worth of shares in the last year. They bought a lot more at 53 billion, and they've also been buying more in Q2, maybe not as much in terms of the disparity, but nonetheless in Q2 and over the last year, institutions bullish and more often than not net buyers. Now, as we said, each one of these we're going to get to our own DCF process, where in fact intrinsically $379 is where we've landed today. Now we'll highlight that we have the free cash flow model year on year. Most recent, they actually had a decrease of 5%, but on average, it sits at 17% over the last 10. We've on 10% moving forwards, but you can see here, low, medium, and high, 8, 10, 12 respectively. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Visa or any others. But 10% with the growth rate, we get the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, getting to 379, indicating a very low 6% upside. Now, reverse DCF model highlighting already baked into the numbers today is 9.2% growth moving forwards. If you believe it should be higher, then to you, undervalued. If you believe, in fact, it should be lower, then ultimately you see this as an overvalued company. We can also reflect, and for transparency, at 8%, 328, indicating downside of 8, and for those a lot more optimistic, at 12%, 437, indicating 22% upside. As always, we like to take through the middle rate where we're not finished because we want to see, does this company have a margin of safety? 10%. We execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode today, we'll buy at 341, indicating not at 10% just yet. If we take a look at 5%, that is pretty much where the company sits. Now, it is a high quality company. There are some issues in terms of expectations around how much stable coins will affect the company, but at a 5% MOS, is this really one to consider adding now? Is it purely just to hold, or in fact, in your opinion, is this one to avoid? Do let us know below. Wall Street themselves see this at 395 into 2026, near strong buy rating, not far off, but they only see 11% upside. So give us your thoughts on Visa overall. We'll also highlight, as we just did, 10% a buy at 341, at 15, 322, at 20, 303, and at 25, 284. Visa, 5% margin of safety. Members of Congress are in fact selling. Let us know your opinion. Before we continue, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of July, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock they've been selling, and maybe surprising, maybe not, just given how much this company has lagged others in the Mag 7 and the market overall, but is Google, where they had a very impressive earnings just days ago. We saw their top line up 14% year on year. We saw their search, which analysts keep on saying is going to die out, up double digit 12%, and Google Cloud, very impressive, up 32% year on year, not only their fastest growing revenue stream, but also the fastest in the cloud industry. We also noted very small but nice to see efficiencies to their gross profit, up 1 percentage point, and their bottom line also up 1. And it's very impressive to see just how quickly their cloud revenue is growing. In fact, it is an increase, 32% Q2. Previous one was at 28%, but this is one area we could ultimately see continue this rate of growth for quite some time. And whilst we rarely cover the YouTube business, one thing that's very important to note here, whilst we see Netflix as one of the largest streaming platforms, the market share over the last few years has only gone from 7 to 8%, whilst YouTube continues to move upwards, 8% 2 years ago, now sitting at 13%. And the company, whilst being up 15% over the last year, year to date, it's only up a very mediocre 2%. Having said that, longer term shareholders still outperforming the S&P, up 488%, trading at the upper end of the 52-week range. Quite surprising, at least to me, that we didn't get to see it in the $200 mark after those very strong earnings. But as we've said for a long time now, this company does seem to be unloved and maybe mispriced by the overall market. We also get a double buy rating from Seeking Alpha and Wall Street, very, very near to the 4.5 to flip this into a strong buy, and it's still giving us an undervaluation signal, forward P of 19.5 below the average of 22. And the blue tunnel also highlighting the undervaluation. Nice to see the blue tunnel not only increasing over time, but after those earnings, we are seeing it move up into the right direction. Although this is one you could have bought for quite some time now in a severely undervalued space. Something that's pretty much held true when we've looked over the last 5 years. More often than not, in fact, this is one that does play in the undervaluation base. But again, investors may have different opinions and believe that it should stay there. And the growth grade at a B, we see year on year and expected this year around the 13% mark, well above the low single digit of the sector, but they are growing slower than their own 5-year average. Earnings per share 15% projected, above the sector at 11.5%, but ultimately, like their revenue, slower than their historicals. And they expect 3 of the next 4 quarters to be growth. Very good to see they've outperformed in the last 4. Projected forward PE sitting at 18.3 on 26 numbers. And whilst we get 40% ownership and 52 billion worth of selling, yes, nearly double the amount of buys in the last year, but actually we notice in the most recent quarter, institutions have been net sellers rather than net buyers, so they've actually been following the same pattern as members of Congress, 2 billion sales, 1.4 billion worth of buying. Now intrinsically we get to $200, and you can in fact see here that we use a growth rate of 10%. If you believe it should ultimately be lower at 8%, then that's actually downside of 10. If you believe it should be higher at 12, 229, 19% upside. Now yes, we will take through the middle rate, but for those that are more optimistic, we'll show the MOS at 12. Also interesting to note, the reverse DCF has around 9.5% of future free growth baked into the numbers. Now based on our $200 intrinsic value, you're not getting a 10% MOS, you're getting around the 5% mark, something we just saw in fact with stock number 1 Visa, and Wall Street. They have increased their price target to $220. They see this at 14% growth into 2026. For those that also want to see, again, 10% buy at 180, at 20, 160, 25, 150. Ultimately though, we only see around a 5% as of today. And as we mentioned, moving it to the 12% for those that are more optimistic, you obviously will be getting a larger margin of safety. Not at 20%, it will be sitting around the 15% mark. Now, are you more in tune with members of Congress and institutions who have been net sellers rather than net buyers? Or do you believe, like Wall Street and Seeking Alpha, this is very close to being a strong buy? Do let us know. Now, it seems like over the last few months, pharma stocks have been having some very bad news. We have Donald Trump coming out to say they're looking to cut drug prices, but then there are other analysts who actually believe this is more bark than bite and perhaps could be a good time to start considering adding. And not to mention the 100-200% tariffs he has been talking about putting on place on many of these big names. But ultimately, we are seeing members of Congress selling names like Pfizer down 18% in the last year. Year to date, down 7%. Over the last 10 years, if you invested 10 years ago today, didn't reinvest those dividends, you would be holding on to less, as we can see, negative 31%. They're also trading towards the lower end of the 52-week range, just one buy rating from Wall Street, although that is fairly weak. And we get a double severe undervaluation signal, forward P 8.6, well below the 5-year of 11, yield massively above the average, 7% versus 4.2. And another undervaluation signal confirmed here, although again very similar to what we just saw from Google for the majority of the last 12 months. This one has been in that undervalued space, and actually over the last 5 years, not that great. What we have seen is the intrinsic value skyrocket just after the COVID period, and ever since then it has been in a downward trend. Now, the growth is at an F. Whilst last year 12% was fairly strong, forward looking they're only projecting 2%. That is lower than the sector at 8%, although pretty much in line with where they have been in the last 5 years. Make matters worse, EPS expected to decrease as well, -1, whilst the sector's up 11% projections, and even their own 5-year is looking a lot better, +3. And they only expect one of the next 4 quarters to be growth, although they do have a 100% historical track record, trading on next year at a forward P of 8.1. Now, institutions with their 68% ownership sold around 12 billion. They bought a little more at 13.9, but we also see in Q2 a little bit more selling. So overall, you could say they are neither really bearish or bullish. And our intrinsic value today, $30, the average of the 4 models, which as always, you can grab a copy by clicking on the pinned comment below. Will give you a margin of safety, but perhaps this is one of those companies that you need a slightly larger amount, nearly at the 20% mark, where we see Wall Street with their $29 predictions estimating 17% upside. Yield is near that 7% mark. Is this one to consider, or at least for those income investors, or maybe one to completely steer clear of? Also for consistency, 25% buy at $22.50. Currently though, just at the 20% mark. Another big pharma company that they continue to sell is Eli Lilly, which is down 1% on the last year. Year to date, up around 5%. Over the last 10, significant outperformance, up 862. Trading around the mid to lower end of the 52-week range, but huge pullback from 52-week high, $973. With another double buy rating, Wall Street again close to a strong buy, and their forward P at 32, whilst looked high in isolation, over the last 5 years it's been even higher at 38, therefore we do get a potential undervaluation point. Yield, however, lower than what's historically offered to investors at 0.7 versus 1.2. But this does give us an undervaluation signal. Nice to see the blue tunnel increasing. Effectively, we're getting the share price over the long term start to decrease, but the intrinsic value move the other way. Always a great sign. But if we zoom out to the last 5 years, absolutely incredible. Pretty much from 2021 to the beginning of 2025, this company was trading at a severely overvalued level. Just recently, and for the first time in the last 5 years, did it ever come into severe undervaluation. And their growth phenomenal at an A+, 36% year on year, 29% projected this year, well above both sector numbers as well as their own 5-year historical. And if we get to the earnings per share, equally as strong, 32% projected, well above both sector and their own 5-year. They also expect not only growth over the next 4, 3 of them double digit, 1 of them in fact Q3 triple digit, but do factor in over the last 4 quarters, they've missed on 2 of them, notably the most recent one, only a 50% track record, but huge EPS jump expected into 2026. If you believe that, well look, forward P estimated 27.2. We can also see institutions holding 83% ownership, selling 45 billion, buying a lot more, and we also see that trend continue in Q2, buying nearly twice as much, massively bullish on Eli Lilly, not something we're seeing at all from members of Congress. And our intrinsic value at 692 for the first time today actually does show us this company, in our opinion, trading at a premium. If we actually take a look, when we use a growth rate of 35%, we're actually getting downside of 15, lower at 30, downside of 40, because right now, already baked into the numbers for Eli Lilly, a massive 37.4% growth. Let me know your thoughts. Maybe you believe it's justified. Maybe, like me, you believe this is way overvalued. You are paying a premium if you are considering adding. Maybe that is why members of Congress are starting to pull back on the company. No MOS, but for consistency, at 10%, a buy at 622, at 20, 553, and at 25%, 519. As we said, trading at a premium in our view. Wall Street don't agree. They see this over $1,000 into 2026, 24% upside. Eli Lilly, buy, hold, or avoid. The next company they've been selling and feels like they have been doing for quite some time now is ASML. If you remember, they reported their earnings not that long ago, where they did say, along with tariffs, it is giving them a lot of uncertainty in their growth. And actually what they have come out to say, which did spook the market, was that they could no longer guarantee growth in 2026. Their earnings though were fairly strong, where it was up 23% year on year. Nice efficiencies to their margin, 2 on the gross, 5 on the operating and 4 on the bottom line. But they have suffered, down 18% in the last year. Year to date, whilst they were up, they've given back a lot of those gains, up just over 2%, and for longer term shareholders, were outperforming the S&P 617%, trading in the mid to lower end of the 52-week range, with a double buy from seeking alpha in Wall Street. But we do get a severe undervaluation signal, forward P26 below the 5-year at 34, yield also 1.05 above the historical 0.8, and we can also see here the severe undervaluation given the disparity. But actually interesting to note, a lot of these companies members of Congress are in fact selling are ones that for a continual time have been trading in a severely undervalued level. But actually ASML, it hasn't been the case for over the long term. We actually note from 2020 to 2022, amid that point, they were in a severely overvalued space. Very rarely do we see it in severe undervaluation. Just in 2025 has that really started to become the case. Now growth at a B, and bear in mind this company is in a cyclical industry, 26% year on year, 10% expected moving forwards. On both accounts it is against the sector, not that far off their own 5-year average. EPS projected 17% growth above the sector, but over the last 5 years, they were growing higher at 22.3. They also project 2 of the next 4 quarters to be a decrease to EPS, whilst maintaining a 100% historical track record, trading on next year numbers at a forward P of 24, and institutions with their 26% ownership buying and selling roughly the same amount in the last year, but we get a little bit more buying in Q2. Now intrinsic value at $909 is derived using a growth rate of 12%, baked into the DCF 8.5. Not a lot would be my initial reaction. I would expect it to be more, and if we use the 12%, we get upside of 28. We'll be conservative, show you the MOS at 10% as well, but based on this rate, you are getting at least 10%, up to 818. At 20%, we can see 727, and at 25, not quite there yet. So for ASML, 20 to 25% MOS, Wall Street 26% upside, their projected price target $900. And if we were to be even more conservative at 10%, you are granted going to be getting a lower margin of safety, pretty much sitting at the 10% mark. ASML, are you siding more with members of Congress, or are you saying this one is a potential buy? The next stock they've been selling, and actually this is also a consistent one, is Micron Technology. They actually had a fairly strong earnings as well as issuing a strong forecast, which is always great to see. If you want to know the particular numbers for the headline, EPS massive beat, 191 versus 160. Revenue also a beat, always great to see. But this one's up only 4% in the last year, but year to date up a huge 32%, Over the last 10 years, another outperformer, up 501, trading in the mid to upper end of the 52-week range. Whilst we get a hold from Seeking Alpha, Wall Street buy very close to a strong buy rating, quant 4.96 out of 5, pretty much telling you where they stand. And we also get undervaluation still even after the 2025 performance, 9.8 below the 5-year of 12, yield slightly lower, 0.4 versus 0.6, but on this model here we do get undervaluation. There is a bit of disparity between the 2 points, and growth looking very strong at an A+, year on year 58%, they're projecting 45 moving forwards. That is well above the sector, but also significantly higher than what they were producing on average in the last 5 years. EPS though letting them down only 5% lower than both sector and their 5-year. And again, nice to see green right across the board. Next quarter, in fact, triple-digit growth. The subsequent 3, strong double-digit, trading on 26 numbers at a forward P 9.1. And we can see institutions holding 81% ownership, selling $10 billion in the last year, buying nearly 50% more. However, they are net sellers in the most recent quarter, selling more, 212 versus 139 buying. And our intrinsic price of $124 is derived using a 20% growth rate. You will find 18.2% is what is baked into the numbers. If you see it lower at the 15%, $90, downside of 19. You may be very bullish, you may see 25% more appropriate, 169 indicating 52% upside. Now using that middle rate of 20%, factoring in DCF reverse just a little bit lower, you are getting a margin of safety at 10%, pretty much is where it sits today. Wall Street very close to a strong buy rating, $153 into next year, 38% upside. Give us your thoughts, buy, hold, or avoid. Transparency and consistency, 20% a buy at 99, at 25.93, but as of today, bang on 10. Now the next company isn't in fact Chipotle, but this may give us an insight into where this company is heading. They've actually said in their most recent earnings that they have gloomy consumers who are buying fewer burritos. Not only that, they're also seeing their comparable store sales growth decline just in this quarter, -4%. And the company members of Congress have been dumping is McDonald's, which is also due to report shortly. They're up 19% in the last year, year to date up 3%. Over the last 10 years, they're up 200%. They have marginally outperformed the S&P. They're trading in the mid to upper end of the 52-week range with a pullback from their 52-week high, $326, with just 1 week buy rating from Wall Street at 3.83. Now the forward P of 23.8 is in fact below the 5-year 25.2. You are getting a higher yield, although marginally, against the historical. And we also get a reasonable valuation here, although bear in mind it is towards the bottom, so soon if it does continue to fall, could in fact be an undervaluation signal. But for the large part of the last 12 months, it has been trading in the reasonable base signal. If we zoom out to the last 5 years, incredibly rare to see this in a severely undervalued space. But their growth, massive letdown, year on year flat, which when you incorporate inflation is in fact a decrease. Forward looking around 3%, pretty much in line with the sector, although lower marginally than the historical 5.2. EPS growth projected 7%, lower than the sector and ultimately lower than their own 5-year. And whilst they do expect growth over the next 4 quarters, out of the previous 4, they have missed 2 of them, 50% track record. Most recent one was just about in line, trading on 26 numbers at a forward P of 22.5. Now institutions with their 70% ownership selling 10 billion, they've bought a lot more at 17 billion, although most recent quarter not too different between buys and sells, so it will be interesting to see how the latest earnings arrives. Now our intrinsic value $323, again remember average of these 3 models, will give you a margin of safety at 10% though, not quite there yet, sitting somewhere 5 to 10. Wall Street seeing 14% projected upside at $340 price target. If you want to see a larger MOS, 10% 291 at 22.59 at 25.243. Give us your thoughts. McDonald's 5 to 10% MOS. Is it a buy? Is it a hold? Or in fact potentially a complete avoid? The next company they are dumping is Procter & Gamble. Now just remember, they are yet to report their earnings, but in the most recent one, they actually cut their full year guidance. The company is down 5% in the last year. Year to date, also down around 6%. Over the last 10 years, up, but again underperforming the S&P. They've noticed that consumers are buying less of their products, very similar to what we saw with Chipotle, perhaps something that is going on with the overall economy. However, trading near their 52-week low, just one buy rating from Wall Street. But we also, similar to McDonald's, get a forward P23 below the 5-year average of 24, the yield on offer above 2.7 versus 2.4, and again very similar to McDonald's in terms of where the company sits, right there towards the lower end, and for the whole last year it has been in a reasonable signal. And actually over the last 5 years, I'm not even sure this company once has been trading in a severely undervalued space. And again, lots of similarities with the previous company. Growth D, no in fact growth in just the year-on-year comparative. Forward looking 2%, lower than the sector, lower than their 5-year of 4, and EPS not looking the best at 4%, again lower on both occasions than the two comparatives. They do however project growth over the next 4 quarters, very low in terms of where the figures actually sit, with a June 26 forward P estimation of 22.6. Now institutions hold 66% ownership, selling 17 billion. They've bought a lot more in fact, and actually very fascinating, members of Congress have been dumping, but we're seeing institutions the complete opposite, loading up 13 billion in the most recent quarter, selling 469 million. Now our intrinsic value, $183, will give you a margin of safety of at least 10%, up to 164, 15% not far off. They're also a dividend king. Wall Street projecting $175, 11% upside. At 20%, about 146. At 25, 137. But in your opinion, Procter & Gamble, dividend king, is it a buy, hold, or avoid? Where do you sit? Do you side with institutions, or do you side with members of Congress? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.